What if the biggest lie in passive income is not that it's impossible, but that it's immediate? Millions of investors enter the market, believing passive income means buying the highest dividend yield today and collecting effortless cash flow tomorrow. But that fantasy destroys more portfolios than most investors realize. Because in serious dividend growth investing, the real objective is not maximum yield. It's durable income growth, powered by compounding. A 7% yield can look seductive on the surface, but without free cash flow, pricing power, a defensible moat, and a sustainable payout ratio, that income stream can quietly become a dividend trap. And many investors don't realize the danger until years of compounding have already been lost. The wealthy understand something different. They do not simply chase income. They buy time, discipline, and businesses capable of raising dividends through recessions, inflation shocks, rising interest rates, and market crashes. Because the real power of passive income is not the first dividend payment. It's what that income stream can become after 10, 15, or 20 years of uninterrupted dividend growth. Today, we'll break down how sophisticated investors actually build long-term passive income using Dividend Kings, Dividend Aristocrats, and one elite monthly dividend payer. And more importantly, we'll examine why income that looks small today can eventually become a powerful financial machine through yield on cost and compounding. Let us begin with Johnson & Johnson, ticker J&J. This is a dividend king with more than 6 decades of consecutive dividend increases. The current forward dividend is approximately $5.36 per share, with a yield near 2.3%. Its payout ratio has recently been around the 60% area, giving the company room to reinvest while still rewarding shareholders. Next is Procter & Gamble, ticker PG. This is one of the clearest examples of a consumer staples moat. Its brands sit inside recurring household budgets. PG recently offered a yield near 2.95%, with a payout ratio around 60.9%, and a 5-year dividend growth rate close to 6%. Third is Coca-Cola, ticker KO. Coca-Cola remains a dividend king with global distribution, pricing power, and extraordinary brand durability. Its forward yield is around 2.6%, and recent dividend growth has been modest but steady. KO is not a rapid growth story. It is a compounding durability story. Finally, Realty Income, ticker O. Unlike the others, Realty Income is a REIT and pays monthly dividends. Its yield is significantly higher, recently around 5.2% to 5.3%. But investors must analyze it through funds from operations, not standard earnings payout ratio. Here is where the passive income lie collapses. Imagine an investor allocates $100,000 across these 4 businesses. The starting blended dividend yield might be roughly 3.3% to 3.5%, depending on entry price. That means the first-year income could be around $3,300 to $3,500. That does not sound life-changing. And that is precisely the point. The beginner asks, how do I get rich from this today? The long-term investor asks, what happens if this income grows for 10, 15, or 20 years? If the portfolio's dividend stream grows at 4% to 6% annually, the investor's yield on cost can rise substantially over time. A 3.5% starting yield growing at 5% annually becomes roughly 5.7% on original capital after 10 years, and more than 9% after 20 years. That is compounding, not hype, not speculation. A disciplined passive income stream built from free cash flow, dividend growth, and time. But dividend investing has a danger zone. The first danger is valuation. Even a wonderful company can become a poor investment if purchased at an excessive multiple. Dividend Kings and Dividend Aristocrats deserve quality premiums, but not unlimited prices. The second danger is slow dividend growth. A high-quality company with a low growth rate can protect capital, but it may not protect purchasing power if inflation remains persistent. The third danger is payout pressure. Coca-Cola's payout profile is higher than some peers. Realty Income's model depends on capital markets, tenant quality, interest rates, and acquisition spreads. A REIT can look safe until refinancing costs begin compressing future growth. The fourth danger is confusing yield with safety. A 6%, 7%, or 8% yield is not automatically better than a 2.5% yield. Often the market is warning that growth is weak, the balance sheet is stressed, or the dividend may be vulnerable. Real passive income is not passive at the research stage. It requires judgment. The passive income lie is simple. People believe income is created by yield alone. But serious dividend investors know the truth. Income is created by ownership, patience, free cash flow, dividend growth, and compounding. The yield you see today is only the beginning. The yield on cost you build over decades is the real engine. A resilient portfolio does not need the highest yielding stock in the market. It needs businesses with moats, rational payout ratios, strong balance sheets, and management teams committed to shareholder returns. So here's the question for serious investors. Would you rather own a 6% yield that never grows or a 3% yield that compounds for the next 20 years? Leave your answer in the comments. This video is for educational and informational purposes only and is not financial advice. Always conduct your own research or consult a licensed financial advisor before making investment decisions.